Meanwhile, after being seized by US regulators over the weekend, First Republic Bank has been sold to JPMorgan Chase. America's largest bank is going to pay $10.6 billion to the US FDIC as part of this deal. First Republic's collapse is the third major bank failure in the United States in the last 2 months, after Silicon Valley Bank and Signature Bank. So the question is, how did First Republic fail? And what does it really mean for the global banking industry going ahead? Well, First Republic's journey began in the mid-1980s. It was founded by James Herbert, who was the son of a community banker in the state of Ohio in the United States. Early on, this bank focused on providing big loans at cheaper rates. Its business model was to lure wealthy customers with preferential rates on mortgages and loans. Then, in 2007, the bank was acquired by Merrill Lynch. It was later listed on the exchanges after being sold by Merrill's new owner, which was Bank of America. But things started to go downhill lately after two other banks, the Silicon Valley Bank and Signature Bank, went under. Firstly, the bank had a high level of uninsured deposits that made it more vulnerable than other regional lenders. And once the US Federal Reserve started hiking those interest rates, First Republic started amassing paper losses. Or to put it more simply, the bank's loan book and investment portfolio became less and less valuable. So, in just a year, its gross unrealized losses zoomed. They zoomed to $4.8 billion from just $53 million. And as per analyst estimates, the bank's paper loss amounted anywhere between $9.4 billion and $13.5 billion at the end of the month of March. So this really brings us to the question, what does this deal mean for JPMorgan Chase? For starters, the biggest US bank is going to grow even bigger as it acquires most of First Republic's assets. The deal would cost JPMorgan a hefty $10.6 billion. But it would not take over First Republic's corporate debt or its preferred stock. JPMorgan's net deposits are expected to rise by 3% even as it gets access to First Republic's coveted, wealthy client base. This, however, may not be the end of the larger crisis of confidence in the banking sector as a whole. And with now one more bank going under, it may only be a matter of time before another similar crisis extends this lingering turmoil. Just to put this in perspective on what's happening with First Republic Bank and the general banking crisis, let's speak to Anurag Singh, Managing Partner at Ansid Capital, joining us from Chicago. Good to have you with us, Anurag. But as far as First Republic Bank now going under, it might be a fall of a bank, but of course it's a gain for JP Morgan, but that's a little later. For the moment, how much deeper does the banking crisis run, in your opinion, now that we have this bank after we've had Signature Bank and, of course, we had these two big banking failures now in the United States. Now the third one, how much deeper is the banking crisis according to you? How deep is it running?
So Vikram, good morning. Actually, good evening to your viewers in India. Vikram, I think it is not a systemic issue. And I think it is very apparent why there is not a panic all around, at least in the banking system or even in the markets. The fact is that this was well known that these two banks, Silicon Valley Bank and First Republic, they both were very, first of all, they're all headquartered in California. They were very heavily focused on lending to the, sunrise sectors, technology, biotechnology, VC funds, venture capitalists, etc. They've had, for example, even, SVB had 97% of deposits which were unsecured, which means greater than $250,000. This bank had about 70% deposits, which were above that. Now, it is not to suggest that these kind of bank runs should happen, because theoretically, anything above $250,000 is not insured by FDIC. So people's money is at risk. So whenever there is a panic, people withdraw the money. The government has done enough to ensure that all the depositors are secured. But I think it needs to do a little bit more, because Vikram, my sense is, regardless of the banking model, you can't have a bank system running where, you say, okay, we will ensure $250,000 deposit per person, but anything more than that is just a free run. You figure out on your own where do you want to be, because beyond a point, then we will just have these big four banks and nobody else. And look how cheaply JP Morgan acquired this years and years of effort by First Republic, right? We can't allow this to happen to all the banks. So something more needs to be done. It's not very systemic, but it is sad to see this happen, Vikram.
Yes, indeed. But when it comes down to the banking crisis, and you're saying that this isn't a systemic issue, we've said that in the first two instances as well, and we've seen how cheaply they've been acquired. But as far as the short term is concerned, in terms of what the Fed is likely to do, because it did get triggered by the raising of interest rates. Now, we are living in an era of heightened inflation, higher interest rates as well. How do you think the Fed's going to move next? Now, going ahead, when these factors come to play?
So, Vikram, 2 points. One is, I do agree, anything which is not systemic can quickly turn into systemic, because ultimately for the banks, there are four banks which are too big to fail. When I say too big to fail, they have been within the government statutes. It is written that anything happens to these four banks, government will come to the rescue. So every single dollar deposited within JP Morgan, Bank of America, Wells Fargo, and Citibank, these four banks, everything is secured. So whenever there is a crisis, all the deposits actually run to these four banks at the cost of these four banks, subject to extremely high level of scrutiny. And I think that's where more work needs to be done, because by a 2018 resolution, anything below $250 billion of deposits, the banks which were considered not systemically big, they were taken out of the regulations. And that's where I think the Fed now needs to catch up. It needs to say that, look, if you want to secure your deposits, open yourself to more regulation. I think so. Some balance needs to be found out. I think work is on in the background, and we'll hear something more on that front. Vikram, in this context, I think the two battles are separate. We've always maintained, at least my personal view, and a lot of thinkers like me have maintained, that these, we can't, there's always something to worry about. You can't let these smaller issues confront the larger battle on inflation, which is much too bigger, Vikram. So I think Federal Reserve, right. It's an open secret, they will hike 25 basis point. But Vikram, look at the core PC inflation data that has come out even now. 4.6 is the core inflation, Look at the wage employment cost index, it is at 1.2%. Now, with those kind of numbers, the battle of inflation is not won. You can't just have a 20% drop in inflation overall and just claim victory and stop. That would be the worst mistake. I think that's what Volcker learned, that you cannot do a start and stop approach here. So I think Fed will continue. I am keen to look at the commentary, but I think Powell
so the Fed can't leave the job half done. Yes, I understand where you're explaining. As far as the situation on the banking front is concerned, that remains a non-systemic issue. It is one of the factors at play, but inflation is the larger battle that you believe the Fed needs to go after, and indeed is most likely to do with a quarter-point kind of increase. We'll keep watching that situation as it develops. Thanks very much, Anurag, for joining us with your perspective on this.